Hey guys, welcome to our YouTube live Q&A. It's Wednesday, September 6th. Appreciate you so much joining us. We're starting to do this every Wednesday at 1 p.m. Eastern, 10 a.m. Pacific. It's been a lot of fun. We've had some really good questions here recently. As we go through, a challenging market environment, there are times when a market feels easier. I would say probably 2021, one of the easier stretches I've experienced, which was low volatility, pretty consistent uptrend, a clear buy on the dip setup. You had stocks overall showing continued strength. 2022, now into 2023, much more of a challenging environment where there are a lot more question marks than exclamation points, I think, to the analytical process. And there are times when I think the market conditions are somewhat clear, somewhat straightforward, when you have a sense of where things may be headed. And then there are other times like right now. So we're going to dig into a couple charts here. The way we like to do the Q&A is I'll start with a couple different sort of setup charts just to get the conversation going. I'll show you some of the things that came up in my own process this morning as I was doing my morning coffee routine of focusing on the charts of interest. And then we'll open it up to the questions. Couple things to mention to you. Number one, if you hit like, we would so appreciate that. We are certainly hoping to grow our YouTube channel and certainly the reach of our live Q&A, which we think is a great way to address questions as they come up. So the more you hit a like button, the more it's going to help us out. So we really appreciate it. Tell your friends, of course, as well. Also, today we are unveiling the Super Chat feature, which is built into YouTube. So if you go in to the chat, you'll see you have an option to do a Super Chat that'll put your question right to the top. We are now not getting to all of the questions that we have. We would love to. So we will certainly get to anything that has the Super Chat little notification on there. We'll definitely get to it. We'll get to as many others as we can. And things we don't get to, we'll put them in the Final Bar mailbag. My show, The Final Bar, runs every weekday at 4 p.m. Eastern on StockCharts TV. And we have a mailbag usually once or twice a week. And we'll take some of the questions we didn't get to and put them in there as well. So thanks, everyone, again, for joining me. I'm going to start with the chart of the S&P 500. I was writing a note for my premium members at Market Misbehavior earlier today, and this was one of the charts that we talked about. A corrective phase, and I don't mean a correction as in the S&P is going down 20%. That is sort of the media's definition of a correction. I'm not a big fan. I don't feel like down 19% is okay, but down 21% is all of a sudden a correction. You need to do something more significant. I think it's more about how the market gets from point A to point B, to be honest with you. I think most technical analysts would probably agree with that assessment. So a corrective period for me is anything that is the larger trend is up, which I think is still true, and the shorter term trend is weak. And so you have a corrective period within a longer term uptrend. I'm still labeling the S&P and the NASDAQ in that fashion until the evidence tells me to think otherwise. And if you look at what's happened here, looking at my chart of the S&P 500 over the last 6 to 8 weeks, is you have an initial down leg, and then you have an upswing, and now we're arguably starting another leg down. And the S&P, of course, trading lower today, down about 1% today. So not end of the world down, but certainly trading lower through the course of this week so far. I think this could be the beginning of wave C. And what that would mean is you have a wave A, which is that initial pullback, breaking below the 50-day moving average. Wave B is sort of an initial reaction to that, where a lot of investors think this is another buy on the dip sort of move. And then wave C is where people recognize that it's going to be a little deeper, more significant pullback. I think we might be starting that. And I'll show you what that means for the chart of the S&P, and I'll show you some of the other charts that give me a little more confidence in that assessment. For the record, if this is a classic ABC correction, as an Elliottician would label it, I think, then if this was wave A from the July peak to the August low, and then this is a wave B, what you basically do is expect a parallel wave, that first move down. You take the end of the wave B and you project that downwards. What's really interesting to me as I'm going through the charts this morning is that actually lines up with trend line support. So if you take the low from October of last year, the low from March of this year, pretty much lines up with the downside objective of that ABC corrective measurement. I am not convinced that the markets are that precise, and I know a lot of people have a precision. They imply a precision to technical indicators. I am not in that camp. I think there's a lot of wiggle room with analysis. I see things not in black and white, but a little more shades of gray. And so I think, getting down to this general area makes a ton of sense. If you think of other things that make sense in this area around 4180, that would be a key Fibonacci support level. It's also the February high from last year, right around 4200, a little below that. 200-day moving average right around 4160, we'll call it 4170. So you have a number of things, what we call a confluence of support all around that particular area. So in my opinion, I think that's what the next leg gets us to, and then you reassess. And I think that's the, for me, that's it. I'm not big into projecting much further than that. I think at that point you reassess and see what the conditions are. Are we oversold as we reach those levels? What stocks are still working and which ones are not, if we would continue in that sort of wave C environment. Now, 3 other quick charts, and then we'll go right to the questions. The next one would be Dow theory, or what's called the new Dow theory. Charles Dow looked at the Dow Industrials and the Dow Railroads, and people look at the Dow Industrials and transports as a, trying to stay true to what Charles Dow actually did 120 some years ago. I am more about modernizing that indicator. So I look at the S&P 500 and the NASDAQ Composite, and those are the 2 lines that we're showing here. If you look, here's the room that the S&P has to get down to 4,200, to get down to a trend line from the closing lows. And so, again, there's plenty of room to pull back even further and still be within a pretty good uptrend. The NASDAQ Composite, not so much. It actually bounced off of that trend line a couple weeks ago, trading higher. I think breaking down there is what tells the story of maybe a rotation away from growth into value. Now, the ratio of value versus growth still very much has been favoring growth stocks, because a lot of the biggest growth names like Microsoft and Apple and NVIDIA and other semiconductors have held up okay, but a lot of other names are actually starting to break down outside of those mega cap sort of technology leadership names. So this might be an important chart to watch to see if the NASDAQ breaks down, and if so, I think that validates sort of that wave C thesis that I was mentioning earlier. Another breadth indicator that I was looking at is this one here, and I've highlighted this chart on my show pretty often. This looks at the S&P 500, then the percent of stocks above their 200-day and the percent of stocks above their 50-day. So above the 200-day moving average, it's actually right down to 51%. It's actually been going down real time today as the market's been selling off. A number of stocks in the S&P obviously breaking their 200-day because it was at about 60% a couple days ago, and now we're down to 51%. This general line in the sand of 50% has been something I've watched for years, and as long as over half of the S&P are above their 200-day moving average, things just aren't that bad. And even if the market feels weak or individual stocks feel like they're in trouble, as long as this breadth indicator remains above 50%, things are just not getting that bad. If it breaks below 50%, not necessarily the end of the world, but it tells me to expect more of a deeper correction in terms of price or time or both. So you see in February, March 2023, we had a price correction. April, May 2023, more of a time correction, more of just a sideways move for a while. But then also, of course, previous pullbacks like the initial sell-off in 2022 had that same thing where we broke below that 50% level. So I'm keenly aware that we are right at that point. Also, percent of stocks above their 50-day moving average never got back above 50% on this sort of wave B bounce. So overall, that sort of plays into the things are not getting better. They appear to be getting worse. And breadth conditions more supportive of a pullback phase that is not over instead of a buy on the dips mentality that I think a lot of investors might still be trapped into. Those are some of the charts that came up in my own process this morning. Again, my morning coffee routine is just get the cup of coffee, look at the charts, and see what happens, which is what I do. I try to do every morning, every trading day. I encourage you to have your own process, ideally using the StockCharts platform, of course, to do that sort of work. We're going to get to the questions here. So as a reminder, the chat is open. The rest of this session will be all driven by the questions that you guys ask. So get the questions in now. We are using the super chat feature built into the YouTube platform. So if you put that in there, that'll bubble your question right to the top. We'll make sure we get to it. We won't get to all the questions, unfortunately, in the Q&A. We'll get to as many as we can, and the rest we'll put in the final bar mailbag, and we'll address hopefully on our show in a coming day or week. Let's see. Question. 2021 was the everything bubble. You have a Patriots logo, so I'm not sure, Andrew, I can answer your question directly. We're not friends anymore. And I did live in Boston for about 8.5 years, but never really turned the corner to be a Patriots fan. So we'll be cheering Geno Smith and our Seahawks on here in Seattle. 2021 is the everything bubble. I think that's actually a really good way of describing 2021. And if you think of 2022, it was like the opposite. Whatever the opposite phrase is to everything bubble, I think that's what 2022 was. And if you think about what marked 2021, shallow pullbacks, low volatility. So looking at the chart of the VIX, I think at times we've had a very similar sort of reading, right? The VIX down in the low teens is a lot like what 2021 felt like. And again, what marked the technical characteristics of that uptrend on like the S&P and the NASDAQ, nice upswings, higher highs, higher lows, very shallow pullbacks. Right? We really didn't pull back more than maybe 5% at most. And I think that was rare. It was more like 2 to 3% was the average sort of drawdown. So everything was just kind of continuing to grind higher. And it was driven by a small number of stocks, but everything started to participate in there. So I wouldn't say we're in that sort of everything bubble now. This feels more like a bubble popping to me. And I see a lot of similarities right around this period, particularly with the AI-fueled rally earlier this year. There were so many similarities. If you were investing, I don't know, in the late 90s, and I didn't. I started in 2000, but my introduction to investing was working with a lot of mentors that was in their prime was during the late 90s. Talk about bubble characteristics. I'm seeing a lot of similarities with valuations of AI-driven themes, and I think we're seeing a lot of that unwind here recently. That might be the undoing of this bull phase here in 2023. We'll see. And go Seahawks. I can't cheer for your Patriots, Andrew. Let's see. Next question, Acorn. Any idea why XLP is underperforming? So is restaurant industry stocks like McDonald's. So is XLP, MKC, GIS, Campbell's. You're mentioning some food products in there as well. So any reason why XLP is underperforming? Well, so I'll give you the snarky answer, which is the XLP is underperforming because less people want to own consumer staple stocks. That is the one thing I'll tell you. And remember, in price, there's a message, right? When something's going down, that tells you that there are more sellers than buyers, or there's an absence of demand, or an overwhelming amount of supply, right? Stocks and ETFs go up and down for a reason. That's up based on the positioning. So I'm a big fan of following where the capital is going, and I think the best measurement of that is price, right? If everyone wanted to own consumer staples, if we as a group of millions of investors all thought the market was going to go straight down, we would get really defensive and we would buy consumer staples, and the XLP was going up, would be going up. The fact that staples are still underperforming tells me that investors, broadly speaking, are not getting too defensive yet. And it's not just the XLP. I think if you look at the XLU, if you look at real estate, you're getting that same message. Right now, we're not getting a rotation away from growth leadership like technology into defensives like consumer staples. We're seeing a rotation from growth leadership into value leadership, things like energy, right? So look at the XLE. Kind of the opposite, rotating higher. So if you look at price, and something like the RRG is a really good way of recognizing that rotation and where things, what's starting to work and what's starting to not work. Here are the growth leadership sectors like consumer discretionary and technology, kind of rotating southwest in the weakening quadrant. Things that are improving, energy, financials, and others, right? So these are the things that are starting to work while the growth leadership are starting to take a pause. You're not seeing a rotation into defensive things like consumer staples just yet, and I think that is an important thing to recognize. Now, having said that, you mentioned a couple individual groups. I certainly noticed today, because one of the things I do every Wednesday is scan for stocks making new 3-month highs and stocks making 3-month lows, and I noticed a bunch of restaurants on the new swing lows list. So here's McDonald's breaking down below support, breaking down below its 200-day moving average today. What's another one in this group? Well, let's see if I can find another one. There are a couple of these that came. Nope, that's not it. There are a couple restaurant names that all kind of came up in that same and look very, very similar to this, right? Maybe Yum Brands would have been one of them. See, so a lot of these kind of breaking below their 200-day, in this case, retesting it from below. So, for me, that tells me to avoid. These are groups that I would probably be leaning away from. And the reason is because the price is telling you that we're going down, right? And that is confirmed by the fact that we're now below 2 moving averages, the fact that we've broken below the 200-day instead of finding support there, we're making lower highs. All of these are the momentum is more negative. So all of these are characteristics with an area of the market that is struggling. Now, the thing with restaurants is they have been doing very well, and now we're starting to struggle a little bit. If you're getting into food products, these things have been struggling for quite a while, right? So I almost said Goldman Sachs, General Mills, GIS. You mentioned like MKC, which is McCormick. What else would be in there? General Mills, we said, Campbell's you mentioned as well. These are all names that have been struggling for a little while here. So I think the reality is, if you think of sectors in three general buckets, which is kind of how I oversimplify it, there's growth offense like technology, there is value kind of cyclical offense like energy and industrials, and then there's pure defense like staples and real estate and utilities. It's pretty clear which of those buckets has been dominating in 2023. That's the growthy offense. And it's pretty clear to me what is now taking the place as growth starts to rotate lower and takes a breather, what's starting to work. Energy, probably the best example of that. The problem is our benchmarks have a very low weighting in energy. They have a big weighting in the growth sector. So if those sectors continue to struggle, pretty rough. Now, looking at things like staples and utilities to see when they start to improve, I think is a really good way to play this market. And if you see things like utilities and staples start to do well, I would say get out of the way and look out below, because that means that the market and investors are getting quite defensive there. Next question. Let's see. Usually there's a sell-off of the market during the 15th to 18th of September due to options expirations. What is your opinion on this September? So there are so many things at play, and I think what you have to remember, it's between economic data, geopolitical data, the election season, any sort of random news flow, earnings, options expiration, seasonality, just pure technical sentiment kind of readings. All of these things are playing together. And I think a lot of times as investors, we want to oversimplify. What does it mean that this breadth indicator did this? And I think you can make that, you can analyze that and draw a conclusion from that, but you have to remember that's just one piece of the puzzle, right? I think a well-rounded investor thinks of all these different components, and I tend to think of it kind of in four general buckets. There's the fundamental, which is what companies do and how they're able to grow. There's the technical, which is the buying and selling that investors are doing and how that impacts price, what the price tells you about the trend and momentum behind the stock. There's the behavioral, which is my mindset and what happens between my ears and my own biases that I bring to the table as I'm making a decision. And then there's the macroeconomic, sort of the big picture, the Fed, interest rates type of thing. If you are focused too much on one of or two of those and forgetting the other ones, I think you are going to be underprepared for what could happen. I think recognizing that all of those are related is really important. So that was a soapbox moment to tell you, when you're thinking about options expiration, remember, it doesn't happen in a vacuum. So the idea that the market would move purely due to just an options expiration, probably unlikely. Now, what you have gotten to is the seasonality. And I think if you look at the chart of the S&P, if you look at where this little arrow ends, I don't have a crystal ball. I can't tell you what the market is going to do, but my very simple measurement of saying a wave A, B, C kind of gets us down in the third week of September, which is kind of the time you're talking about. That's options expiration. That is also, from a seasonal perspective, August tends to be kind of rough. September is probably one of the worst months, and then the fourth quarter actually tends to be pretty strong on an average year, but particularly in a pre-election year, which is what we're in right now. And the seasonality has been remarkably consistent. I remember having Jeff Hirsch, who's the editor of the Stock Traders Almanac. His father, Yale Hirsch, really popularized this idea of seasonality and sell in May and go away and the Santa Claus rally. These are all things that Yale and his Stock Traders Almanac really popularized. Jeff has done a great job of continuing Yale's work and building on it. And I've talked with him every couple months and interviewed him on my show, and it's been tracking really well. The midterm election year, which was last year, usually has a significant bottom in October. That's kind of what happened. The first half of a pre-election year, which is the first half of this year, tends to be pretty strong. That's been pretty spot on. And then August into September tend to be pretty weak. And that's pretty much what we've seen here. The fourth quarter actually tends to be a recovery period. I think that's why we're setting up and sort of in the midst of this corrective play. I wouldn't be surprised if options expiration is one of those things in mid-late September that lines up with a likely bottoming period, and then you rotate higher. And I wouldn't be surprised if the fourth quarter is surprisingly strong. I think the question is going to be what leads there, and I wouldn't be surprised if things like energy and maybe industrial cyclical sectors actually do better than a lot of investors expect. Maybe even commodities, materials. Our last Q&A last week, we spent a lot of time on materials and agriculture names and others. So that's where I would be looking as well. Thanks for asking about options expiration. Good to know when those dates are for sure. And I use the Stock Traders Almanac to do that. Let's see. How do you add D for dividends and E for earnings on StockCharts? Great question. So there are two different parts to the StockCharts platform now, generally speaking, probably three, I guess I would say. The first one would be the scanning tools, sort of the reporting tools, our scooter reports, the RRGs, the market carpets, kind of big picture, what's happening, the scans. I think those are really important parts of our platform. If you're looking at an individual stock like United Healthcare, this is the called our Sharp Charts engine. This is what StockCharts really was started at 25 or so years ago, and it's been updated, but it really looks very similar in terms of its functionality to Chip Anderson's original design of trying to do things pretty in a very simplistic but powerful visual way. What you want to look for is down here where it says overlays. There's this guy that says events. You want to make sure that you click that on. And you can actually customize which events you're doing. I would just put all on there, and then you'll see earnings and dividends and other things as little icons on the bottom of your chart. I actually keep those off because I like to keep my charts, particularly the ones that I show on a webcast, nice and clean. But if you do that, you'll find you have the little icons that'll pop up on your monitor. The other thing you can do is in our ACP engine, which is our advanced charting platform, which is you go to the dashboard, click on StockCharts ACP, or just go to stockcharts.com/ACP. And here is a separate, really powerful charting engine. And again, over time, we're bringing these more and more together. So a lot of functionality will be very similar between the two. That's how we're evolving our platform over time. But this gives us ability to do a lot of really cool stuff as well. And if you go to chart settings, you'll find you have the option to add overlays of events on the same place as well. So down here, so what you do, by the way, sorry, I just went through a bunch of things. Click on the little gears, which are the settings for the chart. Click on the bars. That's just basically the price data, the main settings. And down here a little bit, you'll see things like earnings dates, splits, predefined alerts. We have a bunch of scans that we run automatically, and those will overlay as little icons. You move your mouse over it, and it'll tell you more detail as well. We have a lot more plans of overlaying other events and even custom icons and settings down the road. We'll hopefully get those ready very soon. Thanks for asking about those overlay tools. Let's see, a question from Jay Witt at McClellan 2.7. I guess I don't know what you're talking about. I'm guessing that you're talking about this particular thing. If I go to the Mindful Investor Live chart list, this is the McClellan oscillator. This is a chart I love to use. That has the McClellan oscillator, and it's color-coded. So shaded green means the McClellan oscillator is above zero. Shaded red means it's below zero. As you'll notice, the wave A down, shaded red. And again, what's interesting about the McClellan oscillator, it usually signals pretty early. It's not like some indicators that the price really rotates lower, like moving averages, and then after it goes down a lot, you get the signal that something's changed. The McClellan oscillator usually happens pretty early because it's derived from advanced decline data, but it's actually looking at the changes in that data. So it tends to be much quicker to react. So this getting below zero is a great early warning system that things might be getting a little rocky. That happened at the beginning of August, suggesting a wave A down. We then had this wave B, what I would describe as a wave B higher, and you can see the McClellan oscillator just about a week ago turned back above zero, suggesting bullish configuration. We're getting closer and closer to that zero line. I think that's what you're getting at as we speak. I wouldn't be surprised if we continue to rotate lower and continue to see a distribution day. Could certainly happen today, if not tomorrow. Tomorrow actually might go through there here. We'll see what happens. We process this at the end of the day. We sort of do a big data dump and make sure we have the right closing data. I wouldn't be surprised if this is below zero today, suggesting more of a risk-off feel. And this is more of a tactical indicator, but an important one. This is a great one to monitor, a good one to have on a watch list just to see if it's above or below zero, and just that is a simple measure of trend. Next question, Sherry Wall, you asked, does it look like the techs will uptrend by end of the year? That is a broad question right there. Do I think technology? I guess assuming you're talking about just technology as a whole. So I'm bringing up the XLK. You could easily bring up the QQQ or some of the FANG stocks. Do I think they'll uptrend by the end of the year? Yeah, I mean the funny thing is, I would say some of these are still very much in an uptrend, right? Microsoft, it's not the one I wanted. So what's funny is a lot of the leading technology names putting in a lower high. So while Alphabet looks like this, still making higher highs and higher lows, kind of a Dow theory uptrend. Like this is a chart that is not broken yet. It's a chart that's actually in an uptrend. The momentum is strong. It's a really good chart. But compare that to the chart of Apple, and you can see why technology looks a lot weaker relative to some of those other FANG stocks, like in Amazon I would include in that group as well. Because Apple and Microsoft really sold off here. Apple, of course, gapped lower last month, but then traded back up. And this is where it feels like a buy the dips, which still could be proven outright. But I see this as more of a sell the rips type of environment where rallies are more to be sold because we're now rotating lower. And because of the breadth conditions and just the general trend characteristics that we talked about, the wave structure of the markets, I think it's more of a risk-off type of feel to the tape. So for now, Apple appearing to have a short-term top here around 190 and rotating lower here. I certainly would say if I'm telling you that the S&P and the NASDAQ probably an ABC correction into September and then a strong fourth quarter, the benchmarks don't have a strong fourth quarter unless mega cap leadership growth names are rotating higher as well. But the reality is they might just not go down as much. They might just sort of hold steady. And I think that is a scenario no one wants to think about. But I would argue is probably the most likely scenario. You have to remember that any chart can be in one of three phases at any time. It can be going up, which I would describe as an accumulation phase, can be going down, which I would describe as a distribution phase, or it can be going sideways, what I would call a consolidation phase, where buyers and sellers are generally in agreement, and we're just kind of overshooting and undershooting that valuation. What if Apple and Microsoft and others are not going down? They're certainly not going up right now, but they're not going down. They're more just kind of chopping around, similar to like the chart of GM, right? Sort of in a sideways consolidated field. What's that? What if that's the trend going forward? The good news is there will be charts that are working in that environment. For example, right now, charts like Albertsons in consumer staples, by the way, to the earlier question, making a new 52-week high today. So there are charts that are working just fine, even though I think the markets as a whole, the benchmarks are struggling. I would say, the idea of technology just turning and ripping to the upside, I think unlikely. I will go all in on technology when those uptrends continue. But for now, the big lower high on leadership names like Apple and Microsoft concerning. And I would say for now, more in a distribution phase than anything. Home builders, David Scher asks, XHB, watch out below. It's certainly not going up anymore. And I would say, when I'm looking at home builders, the XHB, it's not a horrible chart yet. And I would say, again, going back to those phases that I mentioned, right? Is this chart going up, down, or sideways? I don't know if I would describe this as going down yet. This is more of a consolidation phase, right? You think between 84, 85 on the upper end, 78 to 80 on the lower end. We're kind of range bound, right? We sort of rallied up to this point and we're consolidating. So, not a great chart, not an Albertsons breaking out, not a Paramount Global, going, oh Lord, can I type in tickers? There we go. Not a Paramount Global, going straight down and breaking down. This is kind of a neutral, right? This is a stock that's, back to home builders. This is an ETF that's sideways. But I think a break below 78, pretty concerning. Now, the problem for the XHB is charts like Lennar and D.R. Horton and Toll Brothers and some of the stocks in that group really more breaking down, right? I think this looks like it's rotated from a clear accumulation phase, higher highs, higher lows, finding support at an ascending 50-day moving average. I'm always looking for what I call a change of character, right? The chart looks a certain way until it doesn't. And I would say charts like Lennar now in a downtrend phase of lower lows and lower highs. I'm interested in a chart like this when it makes a higher low. It hasn't done that yet. It's still sort of in a distribution phase. The momentum is more negative. The relative strength is distributive. I think it could be certainly a big time pause for home builders. And XHB probably not making the case as and ITB kind of holding up a little better. Some of those individual home builder names, I think, struggling quite a bit. The final question. Here we go. I love this one. Let's see. I think I have too many indicators on my chart. I would say if you say that sentence, then you probably do. I would probably, having not seen your chart, you're probably right. And now I'm suffering from analysis paralysis. What advice would you provide for me? I was a better investor before using all these indicators. So I would tell you that I think one of the great things of social media and just communication in 2023 is everyone has a megaphone, right? If you have ideas, you can get it out there and you can have an audience of people that think it's interesting. The problem I have with that whole thing, though, is there's a downside, which is there are no barriers to entry. There are no ethical standards, which is the CMT that I have. We basically take exams and every year sign a thing saying we agree to abide by these ethical standards. And we treat that very seriously. And if you violate that, you get in trouble. And I think that's super important. And I'm frustrated by the fact that not everyone has to abide by those standards. So I see a lot of education on technical analysis. A lot of it is very indicator heavy, suggesting that here's this, and all you need is this one indicator and just follow these signals, and that's all you need to do. Life is not that simple. It really isn't. And I will tell you, if you see a video or article expressing that idea, they are looking at a particular set of circumstances. I'm sure it's working brilliantly for this particular environment. The environment changes. And so I think the benefits of doing a simpler approach with less indicators is that it's more robust. And the word robust in this case means it adapts very well. It's going to work not just today, but tomorrow and next month and next year. So the tools that I'm showing you, looking at price patterns and moving averages, looking at RSI as a measure of momentum, looking at relative performance, what I'd call true relative strength, that's it. I use other things on a limited basis, but the chart I'm showing you is as complicated as I ever try to make things, because the more lines and the more indicators you put on a chart, the more you are opening yourself up to making a bad decision. It feels like the more indicators, it will give you more rigor and more stability. It's the opposite. The more things you put on the screen, when I see someone that has a chart with all these things, the first thing I say is start deleting stuff. So here's what I would do. If you want to take the chart that you started with, I would start looking for similarities. A lot of times people will have RSI and stochastics or different indicators that are very, very similar. You don't need multiple ways of measuring momentum. You need one, and you need to use it consistently. I would encourage you to focus on relative performance as an input, particularly if you're looking at equities and ETFs, because I think that is a key part of the toolkit that a lot of individual investors don't appreciate. I don't think you need a lot of noise on here. I would focus on the basic premise of trend and measuring that trend. How can you define when something's in an uptrend and when is that uptrend over? Watch my show, The Final Bar. The charts that I show you, I think, imply and illustrate that simplicity that I hope you can strive for. But again, the fact that you asked that question means you probably do have too many indicators. You don't need a bunch of indicators. You need a good routine. You need a good systematic process of analyzing simple charts, and I would encourage you to strive for that. That's it for our Q&A. Boy, we went all over the place on this one. These are a lot of fun. I really appreciate you guys joining me. Before you leave, if you would, hit like for us. Subscribe to our channel if you're willing to do so. Helps us out a lot. It would be great to have you back for our next Q&A, but we'd love to spread the good word and get more people involved and help them make better decisions as well. Don't miss my show, The Final Bar, which runs every weekday right after the close at 4 p.m. Eastern. We do it here from the StockCharts TV studio. Today, I have Ari Wald of Oppenheimer, who's one of the best. Does a really good job of simplifying complex markets, so make sure you tune in there. For StockCharts in Redmond, Washington, I'm Dave Keller. Take care and be well. We'll see you next time.